Welcome to StackVest Labs. In this video, we will talk about Japan's recent interest rate hike, the first in years, has sent shockwaves through global financial markets. And today, we'll explore how this decision halfway around the world could contribute to a potential crash in the US stock market. But before we proceed further, if you are new to our channel, then don't forget to subscribe, like, and share it with your friends. In finance, a ripple effect is the spread of losses to non-participants. It's like a rock or raindrop hitting the water, and it can have an outsized impact. This week's market sell-off was fueled by the unwind of the global yen carry trade. The carry trade has involved borrowing cheap cash in Japan and redeploying it into higher-yielding assets around the world, including US stocks and bonds. This video will cover few but main highlight points: Japan's interest rate hike and the US stock market. Number 1. Background on Japan's monetary policy. For decades, Japan has maintained ultra-low interest rates, even dipping into negative territory, to combat deflation and stimulate economic growth. This policy, known as yield curve control, has made Japan a source of cheap capital for global investors. The sudden shift in this long-standing approach has caught many off guard. Japan's monetary policy just took an important step toward normalization. Rising interest rates will hurt the Bank of Japan, which has amassed a mountain of debt to stimulate economic growth and fight deflation. But the Bank of Japan won't necessarily experience pain alone. Other potential winners are domestic banks, which will earn billions in new interest income, and local businesses, especially smaller service companies such as restaurants, hotels, and arts, entertainment, and recreation firms that can benefit from a stronger yen. However, the rise in interest rates will also hurt some household savings, which will see their yen investments lose value, and power-intensive businesses, which will have to pay more for electricity. Number 2. Global carry trade unwinding. One immediate effect is the unwinding of the yen carry trade. Investors who borrowed cheaply in yen to invest in higher-yielding assets elsewhere, including US stocks, are now rushing to close these positions. This mass exodus could lead to significant selling pressure in the US equity markets. Some market participants argue that the relationship between the rising yen and falling US stocks isn't a coincidence. They say that traders were indirectly fueling their leveraged bets on mega-cap tech names and treasury bonds with cheap funding borrowed in yen. Now those traders are being forced to sell stocks and bond holdings to cover their short yen positions, triggering the recent market rout. That spread has been narrowing in recent months as the Bank of Japan stepped up its efforts to lift the Japanese economy out of decades-long deflation. This trend, along with the rise in yen volatility and US interest rate fears, has triggered an unwinding of global carry trades. Number 3. Rising global bond yields. Japan's move is likely to push up bond yields worldwide. As Japanese government bonds become more attractive, investors may shift funds from other markets, including US treasuries. This could drive up US interest rates, making stocks less appealing in comparison and potentially triggering a market sell-off. However, the Federal Reserve is expected to cut rates in September 2024 to allow the stock market to recover and flourish artificially. As the US economy strengthens and interest rates being high in the US, bond yields, the amount of return paid on a bond, are also high globally. That's a problem for savers, mortgage borrowers, and stock investors. But it's also a problem for governments that must pay the annual interest on their massive debt piles. The global bond market is the biggest in the world, with a $130 trillion value. Known as gilts in the UK, treasuries in the US, and bunds in Germany, these securities are the cornerstone of most investment portfolios. The 10-year Treasury yield plays a key role in the valuation of many financial assets, including stocks. Investors use the Treasury yield as a discount rate in models that price future earnings and cash flows. This is because the yield acts as a proxy for the risk-free return on investments. Number 4. Strengthening yen and export competitiveness. A stronger yen resulting from higher interest rates could hurt the competitiveness of Japanese exporters. This may impact US companies with significant exposure to Japan or those competing with Japanese firms in global markets, potentially leading to lower earnings and stock prices. The yen has been rising on expectations that the Bank of Japan will raise rates in an effort to normalize monetary policy. This is expected to cause a shift of funds away from the yen and into higher-yielding assets, such as US stocks. This has been known as the carry trade unwind. A weaker yen improves export competitiveness by making Japanese goods cheaper for foreign buyers. It also helps stimulate domestic demand by making it more affordable to borrow and spend money. However, repeated intervention can lead to market distrust and even retaliatory measures from other countries. Number 5. Market psychology and volatility. The unexpected nature of Japan's policy shift has increased uncertainty in global markets. Investors, already on edge due to various economic concerns, may become more risk-averse. This could lead to heightened volatility and potential panic selling in the US stock market. The Bank of Japan's interest rate hike last week was small, but it sent ripples worldwide. Suddenly, traders realized that a favorite trade in which they borrowed cheap Japanese yen to buy higher-yielding US assets might cost more. The resulting market volatility has the potential to stoke fear, panic, and expectations for a slowdown, creating a risk-off cycle. Recognizing that emotions like greed, fear, and expectation can wreak havoc in financial markets is the first step to better understand how to navigate such cycles with confidence and strategic acumen. This is called understanding market psychology, and it's a fascinating intersection of behavioral finance and investment strategy. Number 6. Potential domino effect. If the US stock market begins to falter due to these factors, it could create a self-reinforcing cycle. As prices fall, more investors may sell to protect their gains or limit losses, potentially snowballing into a full-blown market crash. While Japan's interest rate hike alone is unlikely to cause a US stock market crash, it could be a significant contributing factor in an already fragile economic environment. Investors should stay informed and consider diversifying their portfolios to mitigate potential risks. While Japan's interest rate hike alone is unlikely to cause a US stock market crash, it could be a significant contributing factor in an already fragile economic environment. I hope you enjoyed the video. Don't forget to hit the bell icon to stay updated on more financial videos on the StackVest Labs YouTube channel. Have a great day.